All right. You've all heard of the 4% rule, right? You can retire with the 4% rule, but the problem is the 4% rule doesn't work. It failed. It failed many times. So any of you that are working with somebody that says, oh, we're going to do the 4% rule for your retirement, they're setting you up to fail. What we're going to talk about today on this episode is we're going to talk about a 4% rule, but a 4% rule that the wealthy use, not your old 4% rule. We're going to talk about how you can become the bank using money that's right under your nose that you don't even know that you have. Most people don't even realize that the answer to their income needs, to their wealth growth needs, is right under their nose. The money's there. It's always been there. You just don't know how to tap into it. And that is exactly what we're going to get into today. We're going to teach you how you can crack the code of the wealthy and use their 4% rule to make sure that your income goes up, your wealth continues to grow, guaranteed. And we're going to show you how to use money that you don't even know you have right now. That's what we're going to cover today. So stay tuned. All right, Stephen, let's jump into this. Hey, I got something really special for all of you. I've got something free. So here's the deal. For any of you that want our new book. So here's the new book, Drifting Away from Traditional Car Buying. This is the brand new book we did. It's a mini book, how to keep both your car and your finances in the fast lane. This is fresh off the press. And if you guys want a copy, the good news is by being here, you're going to get it. All you got to do is go to chrisnaugle.com, click on the link for the wealth webinar, and register for next week's webinar episode. Because once you register, you're going to get that book for free. So, Stephen, where do we want to start? Let's jump right into this thing.
Yeah, definitely. Let me get this going here.
So folks, any of you that have been following us, we've been kind of taking you on a journey to building wealth, a journey to learning the secrets of the wealthy and how to make money work for you instead of you working for money. That's the biggest topic we're going to hit today. And Stephen, you love this one, man. I remember this is like the first thing that you remembered that I said. Could you tell that story real quick?
Yeah, no, I mean, yeah, when I was introduced, when I first met you, there's a couple things that stood out. And, when I first saw you present for the first time, you had this slide up and it said, it's never about your actual resources. It's about how resourceful you can be. And, my mindset has always been, it doesn't matter where you are now. If you have the drive and the passion, you can do anything you want. You can accomplish anything in life, right? So when I saw that, I was like, it's so awesome because we work with so many people, especially before what I was doing, that they came from nothing. They didn't have anything. They knew they wanted more. And that's the way that a lot of things happen these days. Or, we also work with a lot of wealthy people or successful business owners, successful people. And even that doesn't matter because they have a lot of resources. But if you can't be resourceful and know what to do with those resources, it's almost a waste. I mean, how many times, Chris, you've been in real estate now for a while, right?
Oh yeah,
since how many? You've done a lot of rental properties. I mean, how many times have you rented? And I don't know if you've done this or not. But tell me, have you ever rented to like a very successful person, like a doctor or somebody that you're like, why is this person renting? Has that ever happened to you?
Right now, to Morningside, I have a doctor who basically rented, and then during COVID, he had to actually extend his rental because of COVID and the need for these types of doctors. So yes, I've rented to doctors. I've rented to a lot of business owners and entrepreneurs that, one guy owns a franchise of a very well-known coffee place. Like, why is this guy renting a house? So yeah, absolutely.
Yeah. And it's in talking with people over the years and just learning about them, like people that are successful are typically very hyper-focused on what makes them successful. So to them, like they're making money hand over foot. They're having everything they need to, live their lives, but they're not necessarily doing what's smart with that money. So what I love about what we do with Money School, and we talked about this last week, the 3 pillars of education, is it doesn't matter if you're starting with a lot of money right now or you're starting with nothing. what we teach by making one change changes everything for you in the future. And that holds true no matter where you're starting right now today. So we're going to go into today topics that if you don't have a lot of money, they're very, very important to learn, because this is a way for you to go out there and get access to money. And if you can solve somebody's problem, it'll create a lot of success for you in life. And that's kind of the basis behind wholesaling real estate or real estate investing, is being able to go in and solve that issue, be able to get that property, solve that seller, that owner's problem, and be able to do what you want and make money doing that in the process. So, we're going to get into that today. But if you have money, if you're sitting here like you're approaching retirement, or you're at retirement age, or maybe you've done well in life and you have a little feeling inside right now that's like, man, the stock market's doing awesome, but I don't want to get stuck holding the bag when that thing comes down. Or if you're watching like, the real estate market and this, everything that's going on in the economy, and everything looks awesome from, out here, like great. But if you have that little feeling inside, like, well, I don't know if that's going to continue, then you got to start learning, like, what do you do right now to protect yourself? And what do you do? So now's the perfect time to learn financial education, no matter what your situation is. So that's what we're going to get into today. And that's really what Money School is built upon, is just looking for those opportunities, understanding how money works, and being able to take action on that and make things happen. And so I'm excited for today.
Yeah, 100%. And, one of the most important things that we're going to get into today is, a lot of people are looking for opportunities to make money, but what if the money was already there for you to take advantage of the opportunities that are being presented to you, or that soon will be? Because, listen, like, let me ask all of you, and type this in the chats. How many of you think the stock market is going to continue on this bullish trend for the next couple of years? Just put in I if you think that the stock market will continue. I just want to see, because we just did a training for What the F Happens. And on the training, we learned a weird statistic. We learned that 98% of all investors out there, 98% of all investors think that the stock market is going to continue to make between 5 and 20% more than it is today. That means that 98% of all investors think that the market's going to continue to grow up to another 20%. Now I listen and I'm seeing all of you commenting in, and the biggest difference is most of you don't believe that. So if the statistic is 98% think that the market's going to continue to go up, but yet I asked that question to a very educated group of people, all of you, just so you know, I consider you the 5%ers. Okay. And I'll get into that in a second. You are the 5%ers, and the 5%ers say differently. Like Tracy just said, definitely not. No way, no way, no way. It just keeps going with the comments. Well, what is the difference between you and the 98% that say the market's going to go up? The answer is very simple. You have additional knowledge that they don't. You know something that the others do not. And it goes right into what Will Rogers always says. Will Rogers quote, you all know this: the biggest problem in America is not what people don't know. The biggest problem is what people think they know that just ain't so. Well, with that being said, you know what else people don't know that they think that they know is they don't know how to make their money work for them. Stephen, like perfect example, housing, real estate. We all live in a house, right? I don't care if you're renting, I don't care if you own, but what has happened in the last couple of years, let's really specifically talk about since COVID, what's happened to real estate prices across the nation?
They have absolutely skyrocketed everywhere.
Like how much though? Like how much have the property values gone up across the country? Do we know the number, the statistics?
I actually don't know the national statistic.
You're in Florida. What have you guys gone up 100% there? I'm just kidding. But if you really look at New York, nobody wants to live in New York.
There's some areas of Florida that are getting, it's not 100%, but we're 50% in some neighborhoods, so to say, 30%. I would say 20 to 30% across the board. It's wild.
So if the property values have gone up 20 to 30%, we got to ask two questions. First off, what is the impact of that 20 to 30% on the average American homeowner? Well, they have a house worth 20 to 30% more. What changes in somebody's life when their house value goes up 20 or 30%? Nothing. How many of you have ever known somebody, maybe it's you, but you know somebody, a friend, a family member, a coworker, and they come into work or at a party and they say, oh my God, I just paid my house off. I'm so excited. I'm throwing a house payoff party, or something like that. Have any of you ever had that happen? Just put in I. If you have, then you're just like me. I've had that happen. I've had people get so excited that they paid their house off. They had a party. And of course I went. I'm like, sure, I'll be there. What are you serving? Oh, you're gonna have beer? Great. I'll be there. And I go for the free cocktails and the vegetarian little snacks that they put out. But then I go up to the person, and there's one in mind. I'm not going to use a name, but I went up to him and I said, hey, listen, let me ask you a question. I said, first off, congratulations on paying your house off. But second off, what's changed in your life now that your house is paid off? And he looks at me and he couldn't answer that. He said, well, nothing. I don't have a mortgage payment. That's enough for me. My mortgage payment's no longer. I said, okay, but now that your mortgage payment's gone, are you taking more vacations? Are you buying a fancier car? Are you, what are you able to do now? Well, nothing. I don't have a mortgage payment. See, here's the problem. Like, it doesn't matter if your house value has gone up 10%, 20%, 30, or 50% in some parts of the country. If you don't know how to make that money work, all that money is lazy money sitting on your couch doing absolutely nothing. So now you've heard me say this before, but I'm going to say it again. Imagine you just worked a really, really hard day. Okay. And I'm going to pretend it's this guy that I went to that paid his house off. He's just got done with one of the worst days. He's miserable. Overtime. Everybody was miserable. Everybody treated him like crap. He comes home, he opens his door. It's dark out, and he looks over into his living room, and right there on his couch with the TV blaring is his money, sitting on the couch, eating his potato chips, drinking his soda, and watching TV while he was out working all day, busting his rump. And the money looks over at him, smiling with little, it's got the Doritos stuff on its mouth and its fingers all over your couch. It looks over at him and says, what, did you have a hard day? When you have equity in your house and that money is sitting lazy in the rafters, you might as well just think of your money as being that money image that I just gave you, sitting on your couch doing nothing. You should walk over to that money and you should say, money, tomorrow you're going to work. You're never coming home. You're never getting a vacation. You're never getting a break. I don't give raises. Hell, I'm not even going to pay you. And your money looks back at you with the little Dorito stains and the orange fingertips and says, thank God. Finally, you are giving me purpose. Your money has no purpose if you don't give it a purpose. Your money can't work if you don't direct it how to work. So that money that's in your house, and all of you have, if you own a house, all of you have equity in your house right now. Whether you think it, know it, or whatever, you have equity in your house. And if that money isn't being used via a home equity line of credit, or maybe a home equity loan, there's many different ways to tap into the equity in your house. Your money is literally sitting on your couch doing nothing at all. So, Stephen, what's the solution to that?
I'm going to tap into it.
All right. So we're going to tap into that, and somebody said, Kevin had mentioned, the market is fixed by the big boys. So does anyone ever really think and know why the market and why the real estate values are skyrocketing? I mean, like, let me hear your opinion, everybody that's watching. Why right now do you think real estate values are absolutely skyrocketing across the country? Let's get someone's answers. I mean, is it because COVID, kind of gridlocked everybody? Everybody was stuck in their house, and they realized they needed a bigger house. They realized they didn't want to be in the city where they are. They wanted a different location, so they're moving now that COVID's kind of pushing through and we're starting to open back up. They want to move out into the country. So a lot of times people are thinking that's the reason. Or is it because hey, everybody's just going from renting to buying? This is the time where we want to create the American dream and own housing. Is that the reason? No, look at these answers coming in. It's amazing. Yeah. I love Joanne's. Go ahead, Stephen.
Well, I was gonna say, I hear this a lot, like, cause we saw the most recent housing bubble and crash was not that long ago, 2008. So I hear this a lot, like, this isn't the same thing. This is completely different, and they're right and they're wrong. And we're going to talk about that too, but go ahead with these comments.
Yeah. I mean, it's amazing. Like, there's a government's printing a ton of money and putting a lot of stimulus money out there. Some of it is, demand and lack of housing. That's a massive thing. Supply and demand is a huge reason for this. But why is there a lack of housing? Is it people
Right.
are afraid to allow people in their house to view it because of COVID? Well, maybe that was the case. Maybe that's a piece of it. Or could it just be that the hedge funds, the iBuyers, the giant institutional funds like BlackRock and Blackstone are actually out there buying up all the houses 20, 30, 40% over ask? Did you ever ask yourself, is it really mom and pop, your brothers, your sisters, your friends, your family that are buying all these housing? Or is there maybe something else out there buying all this housing?
And I
Well,
think that's a very regional and geographic way to look at it, because if you look at the country, right, outside of the suburbs, so let's say 5 to 10 miles out of like major cities, those types of areas, I think a lot of that demand is the people moving out of the big cities. Okay. Down here in Florida, where I live, Florida's always been a very positive state for people moving here versus people leaving, but it was really, really drastically increased. Like the numbers are mind blowing how many people are moving here because of COVID, because we've had the least amount of rules and regulations. We've had some of the best numbers and success when it came to that. And we've had freedom. Like we've been, we've been open since, well over a year now, things back to almost normal. So, and that drove a lot of people here, plus everything else that always has been like weather and stuff. So here, not as much, but like when you look at other areas, like places in the Midwest and places that like, what is driving demand there? Like what, like nobody's leaving. There's no big cities for people to run from. It's not necessarily a better state to move to. So like, why is that? Why is the demand there being driven? And why are those prices skyrocketing? And I think, Chris, that is what you're saying right now with the big iBuyers and hedge funds buying everything up. I think that's where they're going, and they're trying to create these rental communities, and you see a lot of that. So I think it has to do a lot with regional too.
yeah, and I think there's a lot to be said about that. I think, it's not just the iBuyers, it's not just the big hedge funds. It's in areas like Florida and Texas where people that live in California or New York, I'm sorry, we don't want to be here. We don't want to be here. We've been so clamped down, and everything's, all about high taxes, more taxes, pay us more, give us more. And we just want freedom. So that freedom exists in states like those two. But, what about Arizona? What about Salt Lake City? What about some of those other states where a lot of people are moving to that really don't have what Florida and Texas have?
Yeah. And a lot of people have hit on it. Low interest rates. I mean, artificially low interest rates. They've just driven those so low. It's so cheap to borrow money right now. And banks have so much cash, they need to lend it out. So they're doing loans whenever they can, and they're getting that money moving. Again, we talk about it all the time. The only way to make money is to have your money moving at all times. And that's what banks do. That's why we mimic banks with everything that we do. But they know that best. They need that money out there moving. So they want that money to go to mortgage. They want that money, people buying houses. So they're going to give that money out when these interest rates are so low. And I think that is a huge part of it. And it's so what's going to happen when those rates start to rise? I mean, what's going to happen? And somebody else had a good comment on here about the housing starts and the cost of new construction. So it's hard to build right now. It's more expensive to build. So that drives the secondary market as well. And I agree with that too.
Yeah, no, you're absolutely right. I mean, there's so many headwinds coming at us. Like if you're flying an airplane, you want a tailwind. Heck, you want a perpetual tailwind, but that doesn't exist. So the only thing you can really do in an airplane is wait for the proper environment to fly the plane, because too many people out there, and I'll just talk about like airplanes because I'm infatuated with them. If you had 100-mile-an-hour headwind and you took a plane off and you had to go from, let's just say, Florida to Chicago, and you were going to be going into the wind, 100-mile-an-hour headwind, your plane would literally not go anywhere. So you would take off, and if you had a headwind of 100 and your plane went 100 miles an hour, you wouldn't go anywhere. You'd literally just, circle and then have to land. You would get nowhere. But if you just waited for that wind, that environment to change, and then all of a sudden you took off when you had a tailwind of 100 miles an hour. So now the wind's behind the plane. Your plane, instead of going 100 miles an hour, now is traveling at 200 miles an hour. You've all experienced this in jets, right? They fly. Sometimes you get somewhere much earlier. Or if you look at the time to fly from, Florida to California, let's just call it 6 hours. But then to fly from California back to Florida is only 4 hours. The reason of that is the environment, the tailwind. So too many people out there want to spend time and money to make their plane go 105 miles an hour instead of 100. That's what they try to change. They try to change the plane when really what they should be doing is, just change the environment that they're flying in. The same thing holds true with your money. You can 100% change the environment in which your money operates if you choose. Or you can continue to operate the way you are in somebody else's environment, i.e. the banks, i.e. Wall Street or other areas. And in that, you are always going to be facing that environment. And that environment will be ever changing. Sometimes it's a headwind, sometimes it's a tailwind. Think of the stock market. Does the stock market only go up? No, it goes up, down, sideways. But what happens with what we do with the privatized banking, with being your own bank? You create a perpetual tailwind. You are controlling the environment through the machine that you actually operate and run your money through. And that is the pure definition that Nelson Nash gave on uninterrupted compound interest. Instead of trying to change everything that's not really going to change much, making your plane go an extra 5 miles an hour or your car go an extra 10 miles an hour, why not change the environment in which we operate in? That is possible. So let's get into the environment in which your money is going to operate and where that money is going to come from. So we already talked about the 5%. And I mentioned this earlier. So this is not going to work for everybody. We've got, well into the hundreds of people on here today. And the beauty is all of you are the 5%. But what is the 5%? Well, let me define that. If we went around and we interviewed 100 20-year-olds, think about a 20-year-old that they're optimistic, they're ambitious, they're ready to conquer the world. They haven't been kicked and beaten down enough in their life to not have dreams still. So they're ready. So if you asked all 100 of these 20-year-olds if they're going to be successful at the age of 65, they'd all say, yes, absolutely, I'm going to be successful. But now let's fast forward to age 65. To what we would call the retirement age in this country, age 65. What happened to those 100 20-year-olds statistically? Well, I'll tell you, only 5 of those 100 optimistic and eager 20-year-olds are going to be financially successful. The other 95% are not. The other 95 of those 100 20-year-olds are either still working, not where they want to be financially, dead broke. I mean, right there. 1 is wealthy, 4 are financially secure, 5 are still working, 36 are dead, and 54 are dead broke. Like, listen, folks, we didn't make these numbers up. You see that little blue thing? It says Social Security Administration. These are the statistics. 100 people, and that's what's going to happen in the greatest country on earth, the land of opportunity. The difference is, and I've said this before, 1 of those people, or the 5%, we'll just say the 5%, right? 5 of them, the 1 wealthy person and the 4 financially secure. What did they do different than the other 95? They changed the environment in which they operated in, just like we talked about with uninterrupted compound interest. What did the 95% do wrong? It's not that they did anything wrong. It's that they chose to conform. They chose to operate in someone else's environment, somebody else's perception of where their life should be. How many of you know somebody that when they were a kid, right up through high school and college, their parents tried to drive them to be something or a specific profession, let's say a doctor? I know a lot of people that are clients of ours that have said that, their parents and their grandparents wanted them to be doctors. They sent them to the best schools they could. They racked up lots of, financial debt so that their child could be a doctor and successful. But what happens if that child doesn't want to be a doctor? Now what you're doing is you're making that child conform to your ideologies, your views, and your perception of what your child should be. That's the difference. I'm not saying doctors aren't successful, but if a doctor doesn't want to be a doctor, if there's no passion, there's no purpose, right? So how can that operate? So creating wealth. First off, Stephen, let's get back to real estate. Let's get back to the 4% rule. I mentioned it earlier. So what is the 4% rule? Well, being a financial advisor for 16 years, and Stephen, you were an advisor with Ameriprise for quite a long time. We were always taught about the 4% rule. And what was that 4% rule? Do you remember, Stephen?
Yes, but I like the way you explain it. So if you could keep rolling, that'd be good.
Sure. The 4% rule is simple. There's 2 different, we always categorize 2 different things. There was the accumulation phase of building wealth. That's where you're investing, you're building portfolios, the advisor's helping you build your wealth. Then when someone retires, let's just say 60 or 65, we switch over to a distribution phase. This is where we're going to take all those assets that we've built and we're now going to distribute them. And how we did the distributions, and this is a very well-known, sought out, like thought of strategy, is it was called the 4% rule. We're going to take 4% from the portfolio each and every single year as income. So if you got $1 million, we're going to take $40,000 a year. That's 4%. We're going to just live off of the 4%. And statistically, based on this rule, and maybe not statistics, but based on the math of this rule, what it was is we should always be able to earn 4%. In most cases, back in the old day, we could get 4% guaranteed. Well, let me ask all of you, how many of you are getting 4% on your bank account right now? Any of you? Okay, I'll chalk that up as a no. How many of you are earning a guaranteed 4% in any of your investments at your brokerage or in your 401k, maybe the fixed account or that G fund, you know, that's in your government 457 plan? Anyone getting 4% there? Your TSP? Probably not. Most of those fixed accounts don't pay 4% anymore. They're down to like 2. Some of them are 1.5%. Trust me, I know. So if the 4% rule is designed to provide the proper distribution that will get you to the long haul. What's the long haul? That you never run out of money. That's the long haul. So if you subscribe to the 4%, but now in an environment that we're in right now, if you subscribe to whatever environment is being dished up right now in the markets, are you able to retire comfortably without ever running out of money if you're taking 4%? The answer is absolutely not. How about 2008, 9, 10? Could you have operated in a 4% environment and actually never ran out of money? No. But some of you would say, yeah, but Chris, then the market comes back up and I'm making 8%. Here's the thing that most people don't understand. And this is why the 4% rule fails, is because people don't understand the damage that is done to a portfolio when a stock market goes down. Let's just use last year, right? I always used to use 2008, but 2020, during COVID, the market fell 30%. Well, let's say you were doing the 30% rule and the market's down 30%. You took out income when the market was down 30%. You took out income the next month when the market was down 20%. You took out income the next month when the market was down 15%, and then on and on. So you took money out when the market was down. When you do that, the damage is irreversible because that money's already gone. You've taken it out when the market was down, which is what most people would do. There's no coming back. Now, all of a sudden, all the calculations and all the predictions that you had on your portfolio and on your assets are out the window. You have to recalculate and you have to redo it. And you hope to God that you don't have another downward pressure or another down market. But how often do the down markets hit? Well, if you look at the patterns, every 10 years. Then there's another major pattern at 45 years and another major pattern at 90 years. Most of you are like, well, Chris, I'm not going to be around 45 years or I'm not going to be around 90. But I just want you to understand the patterns. Every 10 years, it's actually 7 to 10, we see some type of a dip, some type of a correction. And I know a lot of people are thinking, well, Chris, no, this one, it's been strong since 2008. Wrong again. 2011, the sovereign debt crisis. That was a doozy. I was an advisor during that period. Stephen, were you an advisor in 2011?
Not then, no.
It was awful. It was awful, but nobody remembers this. Greece was going bankrupt. Their debts were all falling apart. The EU had to bail out Greece and God, there was so many other places, and I'm going to get them wrong if I try to remember. But during that period, the market fell pretty substantially, nothing like 08 or nothing like COVID, but it fell substantially. So if you were retired following the 4% rule, you were taking money out of a downward spiraling market. And then again, it happened, when Trump came into office, the market went down. And there's all these other periods where the market went down that nobody remembers. Everybody remembers the big ones, the Great Recession, the Great Depression, the dot-com crash, the COVID crash. Nobody remembers all those other periods during these 10-year cycles or 7-year cycles where the market dips. But if you're retired, you do. Because all of a sudden you start looking at your balance, your portfolio that your advisor said, hey, we're never going to run out of money if we just follow the 4% rule. Then all of a sudden you're looking at your portfolio and you're like, honey, I think we're going to run out of money. Well, and then your significant other or your wife says, how is that even possible? The advisor said, if we just follow the 4%, we only take 4%, which is barely enough for us to live on, we'll never run out of money. Well, honey, the advisor said that was great when we said that, but he didn't expect the Great Recession. He didn't expect the COVID dip, and we've been taking income the whole time. And yes, there is another crash coming, folks. There is another storm coming, and it's coming soon. When? I don't know. Can't time the market. Could be this year, could be next year, almost certainly will be by 2023. And what's that crash going to look like? Well, let me just paint a picture for you. Take the 10-year cycle, the 45-year pattern cycle, and the big one, the 90-year pattern, and put them all together in a blender and hit start. What you have is what's coming. It's going to resemble the Great Depression. Don't believe me? Start following some economists, start reading, because everybody's talking about it. Warren Buffett's selling his parts of his portfolio. Bill Gates selling large parts of his portfolio. Zuckerberg selling large parts of his portfolio. But the best one to watch outside of Buffett would be Ray Dalio. Ray Dalio is all over the news. This man is a multi-billionaire, runs and created and founded the largest hedge fund in the world, manages China's money, just to give you an idea. It's called Bridgewater Capital. Just watch on YouTube a couple of his interviews. He has nothing to gain. Man doesn't need any more money. Nothing to gain financially by going on, but he's putting the warning bell out, telling people, here's what's coming. So you don't think there's a crash coming? Then why are all these massive, massive billionaires, these giant icons, selling or warning you that there's a storm coming? Well, here's the thing. If you're retired or looking to retire, and you're going to follow the 4% rule because that's what the advisor or the banker or somebody else told you, it will fail, because it always has. Well, not always, but at least for the last decade, it's failed, and it will continue to fail because the things are different. The environment is changing too rapidly to actually have that work. So what is your hope? How do you actually survive? Well, let's talk about the real 4% rule. The 4% rule that the wealthy subscribe to, which is an environment change, right? It's where you actually operate in an environment that you create. Let's talk about the equity in your house. Okay, very important right here. We're going to get into this little house here. That's a cute little house, right? Any of you have a house that looks like that? You know, really cute. It's kind of small, maybe 1,200 square feet, single car garage. I grew up in a house that was 700 square feet, 2 bedrooms, and a detached 1-car garage. So this is very, reminiscent of what I grew up in. This house right here represents the single largest asset in most people in America's lives. Their house is their largest asset in most cases. So now they've been paying down their mortgage. They've got all this equity sitting in their house, but they're pinching every single month just to get by. Groceries costs just went up. Lumber prices went up. Fuel costs are going up. Everything around them, the price is going up, except for the one thing that's not going up is their income. But yet they've got this house, their single largest asset that they've been paying on, that now has a ton of equity. So what are they going to do? Well, most of them do nothing. Or some of them will take out a home equity line of credit at their local bank, which in most cases costs you $0. They will take that home equity line of credit and they will then go out and remodel their kitchen, remodel their bathroom, thinking, oh, I'm going to increase the value of my house and get more equity. Is that a smart way to use the equity in your house? No. Some people, the really not smart ones, will go out and buy a boat. They just moved to Florida. They have equity in their New York house, and now they want a boat. So they take the equity out of their house and they buy a boat. Is that a good way to use the equity? Absolutely not. All those people that are taking home equity lines and putting that money back into a new kitchen, a new bathroom, a boat, a new car, whatever, they really need to read Robert Kiyosaki's book, Rich Dad, Poor Dad, because Rich Dad, Poor Dad talks about cash flow. Talks about one of the most important things. The rich people of today will be the poor people of tomorrow. That's what he talks about in Second Chance. Okay, so let's get into the equity. If you've got all this equity in your house, well, what do I do with it? Well, first off, why don't we learn how to do what the wealthy do? The 4% rule. Why don't we learn how to make that money, the equity, that lazy money on your couch, work for you? Well, how do you do that? Well, Chris, I don't know how to do that. Well, let's think of this. Your home equity line of credit. Let's just keep numbers simple. Just look at the screen right here. Let's just say you had a $100,000 home equity line of credit. And if you took all $100,000 from your home equity line of credit, they would charge you 5%, which means $5,000 a year is the interest they would charge in that home equity line of credit, assuming an interest only, or $416 a month. Well, that sucks. Take $100,000 out. Now I just got a $416 a month bill that now I have to pay. That doesn't make me happy. So that wouldn't make you happy because you haven't changed your environment yet. Now what we need to do is we now need to make that money work harder for you. So if it cost you 5 to use money, but yet you knew a place where you could put that money to make 10, how about a risk-free 10? Okay. What about something with low risk? We don't want to put that money into the stock market because the stock market's at a high point. But what is a really safe place to put money? Well, let's look at the banks. What do the banks do? What are the hedge funds doing? What are the iBuyers, the BlackRocks, the Blackstones doing? They're buying real estate. Why real estate? Why wouldn't they just keep putting money in the markets like they always do? Because real estate, they understand, is the best long-term investment there is. So, Rockefellers way back in the day made a comment. They said, own nothing, but control everything. How many of you have heard that statement? Own nothing, control everything. Say I. Many people have heard it, but how many of you truly understand that comment? Say, I do. If you understand what own nothing, control everything means, please put I do. It's actually very simple. So if you want to own nothing and control everything, what you should first look at, if you're trying to learn how to do this, is look at the banks. What do the banks do? Well, they own nothing. Well, I shouldn't say that, but for the money that they're moving, they don't own it. They just control it. How do they control it? Through a lien, through a mortgage. So what if you took that $100,000 home equity line of credit? You took part in, something like the Private Money Club, which is a community for lenders and borrowers, and you found yourself a good borrower that's looking to borrow $100,000. And they've got a great house that you looked at, and you had, maybe you hire somebody to do an analysis, you have them pay for the appraisal so you can see what the value is. And you say, all right, I'm going to lend you this $100,000 for this real estate deal you're doing. I'm going to lend it to you for 6 months at 10%. Okay. So if you lent it at 10, but it cost you 5, what is your arbitrage? It's 5%. So right there, if you did it for a full year, you'd make 10 grand. If you lent this money out with a first secured lien position, that's $833 a month. Do you realize if the cost was $5,000 or $416 a month, but you lent it out at $10,000, $833 a month, you literally just put 5 grand in your pocket. And did that 5 grand require you to work any harder? No. Did it require you to work any longer? Absolutely not. Did you have to take on any additional risk? Maybe a little bit, because the risk is that that person you lent the money to doesn't pay you back. But it's secured, isn't it? Yes, you have a mortgage. And if they don't pay, what do? You foreclose on their entity. You never loan to an individual. You never, ever want to lend money to an individual. You always want to lend money to an entity, because now you're in the commercial world. And now foreclosure is much simpler, much easier. Any attorney will tell you, consult with your attorney about this. But in doing that, you've got a tangible asset securing your $100,000 loan. You don't have to control. You don't have to, own that property. You just have to control it. And do you control it when you lend money on a first secured lien position? Stephen, who's in control on that deal?
You are the lender.
Absolutely. How many of you have ever not made your car payment to the bank? Did you not figure out who was really in control of that car? Because you thought you owned the car, but you stopped making that payment. And then some tow truck shows up in the middle of the night and you no longer have a car. Were you in control? No.
I was going to say, stop making your car payment, and every tow truck you see, you're going to be shaking. Is that one for me?
Oh, I love it. So it's so good. But I just right there, I just want you to understand, there is a way for the average person to do what the Rockefellers, one of the wealthiest families, if not the single wealthiest family in the world. It is stated, now, this is not factual, so don't shoot the messenger, but I have seen that the Rockefeller family has a net worth of well over $100 billion. And I think it's significantly more than that. They have done this without owning anything and simply by controlling everything, by being the bank. The Rockefellers are nothing more than bankers, but you think bankers just own banks. No, they apply banking principles, which is what I just showed you. If you have equity in your house and you're not tapping into that equity, and we're going to cover some of the ways you can do that in just a second. If you're not tapping into that equity, I got to ask you why. Many people would say, well, I don't need the money. Well, I wouldn't qualify for it, or I don't want another loan. Well, if you don't use the money, does it cost you anything? Nope, not a penny, not a penny. Maybe it hits your credit score just a wee little bit, but if you have access to that money and, let's just say 2 years, 3 years from now, the whole market tanks. How many opportunities do you think are going to come at you and every one of us when the market tanks? All of the opportunities. When there's blood in the street, what should you do? Stephen, what do they say about blood in the street?
That's right. When there's blood in the streets, it's when you get out there and you buy.
That's
Make
right.
things happen.
You know, when others are fearful, be greedy. When others are greedy, be fearful. Warren Buffett says it best. So let's talk about this hidden equity and this banking technique, because that's all this is. It's a simple arbitrage. That example right there of you using the equity in your house, the lazy money, has some downfalls. Number one, you could go to your bank or your credit union and they could deny you. They could say, no, Chris, you're not going to qualify for this home equity line. And you might be like, well, Chris, I gave it my best shot. Sorry, I didn't qualify. I didn't have the credit. Are you dead in the water? Is there no other options? Absolutely, there's other options. If real estate's the greatest investment on earth, are you the only one that knows that? Are you the only one that thinks that? No, everybody knows that, including large private equity firms. Pension funds know that. So let's just talk about pension funds. Do pension funds need money today or in the future to pay for a benefit? In the future. So if you're a pension fund, you need to make a return, but a very low risk return. So would you be okay if you were a pension fund making 4 to 5% on your money? Well, maybe you don't know, but I'll give you the answer. Yes, absolutely. Why? Because you're keeping pace with inflation. You're beating inflation by a couple points. And over the long haul, pension funds understand the simple principle that we all understand very well at the Money Multiplier, and that is uninterrupted compound interest. If we put money into something and that money compounds year over year over year over year, even at a small percentage gain, 2 or 3%, there will be a ton of money later. If any of you haven't seen our other videos, I urge you to go to chrisnaugle.com and just watch the videos talking about uninterrupted compound interest. It is single-handedly the most powerful thing in the financial universe. Well, Albert Einstein called it the eighth wonder of the world, the most powerful thing in the universe. And he said, those that understand it, earn it. You're the 5%ers. You need to understand this because the Rockefellers do, the Rothschilds do, the Walt Disneys did, the Ray Krocs did, Joe Biden does, McCain did, Warren Buffett does. If all those people understand compound interest, that's why they earn it. But then there's the others that don't understand compound interest. What do? They pay it. They pay it. You don't want to be on that side of the coin. So, with that being said, I mean, let's jump a little bit further. So that's part of the 4%. The other thing too that we can add to that is we can put a perpetual tailwind behind 100% of your money. We could add one step to that equation that I just mentioned. Right there, we took the loan from the home equity line, and we then took the home equity line and we lent it out to somebody in a first lien position. Now, that's not your only option. I just gave you one. And in that process, you made a spread of 5% or $5,000 per 100,000 you loaned. Well, let's just say you don't like lending money. Well, you could get a home equity line of credit. You could wait for an opportunity to come at you. And I don't know what that is. Maybe crypto or something is your thing you like. Maybe crypto drops to 20,000, Bitcoin drops to 20,000. You buy it there, you sell it at 40. You see what I'm saying? There's tons of opportunities, but you have to have access to the money. I was talking about pension funds. So private equity firms like Quantum RE, and Stephen, can you put this in the chat? Quantum RE is a company that is a bunch of private investors that have pooled together pension funds and a bunch of big money. And what they do is they will actually advance you or give you the equity in your house. They will give you that equity today. And you will not have to, there will be no debt. There will be no monthly payment. So what gives? Pension funds aren't just giving away free money these days, are they? Well, not exactly. But pension funds and private equity firms are willing to take the gamble on the long term because they can. You can't, they can. Quantum RE will, if you qualify, and how do you qualify? The right state, have equity in your house, a couple of criteria, but it doesn't have anything to do with your credit score or any of that other stuff. So what they're going to do here and follow closely. If you don't qualify for a home equity line, this is a great option. Quantum RE will give you up to 80% of the equity in your house. Okay. They will then not charge you a monthly bill. They will not have any debt. They will become a lien holder in a second position if you have a mortgage on your house. And what's the catch? What's in it for them? Simple, very simple. In 10, 20, or 30 years from now, when you decide to sell your house, they're banking and betting on your house appreciating over that period of time. So when you sell your house, there's going to be an agreement between you and Quantum RE where they're going to share in some percentage of the future appreciation. Future appreciation that isn't even there today, that doesn't even exist today, but yet you get the money to use today. The most valuable money you will ever have is today's money. Tomorrow's money will be worth less. The money in the past doesn't exist, but it was worth more. So if your money is worth the most today, the goal is to get as much money as you can today and make that money go to work right now. But what they're going to do is they're going to share in the future appreciation of your house. So for example, in some cases, maybe it's 30% of the future appreciation. Your house is worth 100 grand today. They give you 80,000 because your house is paid off. So you got 80 grand in your hand. You don't ever have to pay anything. 20 years from now, you sell your house. Your house has gone from 100 to 200. They're going to share in that appreciation of 100,000. The house appreciated from 100 to 200. So that's a $100,000 appreciation. You're going to share with them 30% or 30,000. So when you sell the house, you make 170, they get 30 because they shared in 30% of your future appreciation. Does that make sense? So a lot of people are like, well, why would I do that? My question would be, why would you not do that? It doesn't make any sense. You got 80 grand today to use to put to work today. How much will that 80 grand be worth in 20 years from now if you move that money like I just showed you? A lot. I don't even know.
And there's no debt. So you don't have debt on the books. You don't have to worry about debt to income. You don't have to worry about paying it back, which, so we take that example you just showed where you're making $400 a month because the other 400 goes to the repayment. But here you'd be making the full $833 because you don't have anything to repay right now. So It's just a beautiful thing.
It's an absolute beautiful thing. But again, this is just simple stuff. This is just how you actually use and move your money today. And, everybody's always got an excuse. We talk to hundreds, if not thousands of people, every single year. And everybody's got some kind of an excuse why they're not where they want to be, why they don't want to, get where they are, or why they don't like doing this or that. But the excuses really can be knocked down very easily when you just show the math. See, people lie. Sometimes things can be looked at as being too good to be true, but when you just boil it down to pure mathematics, math doesn't lie unless it's manipulated, but math in its truest form does not lie. So if you just run the math, if you pulled up on bankrate.com, a compound calculator, and you put in, let's just use that example. You put in $80,000 into that compound calculator. I don't know, do it for 10 years, do it for 20 years, do it for 30 years. Doesn't matter what time frame. And then let me know how much money that 80,000 would turn into if it was allowed to remain like in a constant state of uninterrupted compound interest. But most people would say, well, I don't know, if I had 80 grand, how would I earn uninterrupted compound interest on that money without interrupting it? What if I need that money? Well, this is where you step into the secrets of the wealthy. This is where many, many years ago, I feel like I cracked the code. And there's a lot of books about this. There's a book called The Banker's Code. There's the 501k. There's Nelson Nash's Becoming Your Own Banker. There's our book, Mapping Out the Millionaire Mystery, right behind me. Lots of books on this. Okay. You can read, listen to Tony Robbins. You can watch Robert Kiyosaki. They're all talking about the same darn thing. And this is going back to what I said. You need to change the environment in which your money operates. In this environment, this secret, this cracked code environment, what is it? Privatized banking. What is privatized banking? Specially designed and engineered whole life policies. Now, as soon as I say that word, how many of you like whole life? Say I. And this is going to be different because we do have a lot of new people on there. But how many of you, when I say whole life insurance, how many of you love that? Put I. Okay. Then I want a second question. How many of you hate whole life insurance or you don't like whole life insurance? Just put the letter or just put no. I want to see that. So all the people that are putting I, there we go. Okay. Jamie put no. Michael's the term guy. Who else does not like whole life? Just put no. I want to hear that. We got a lot of I's. So a lot of these people have been around our campfire for a little bit, but I'm going to get into this in a second. So, all right, we only had a couple of people that put no, but I'm sure there's a lot more of you that, yeah, see, Vinny said, I don't know. He's kind of like on the fence. He's like, I don't know. Dave Ramsey said whole life sucks. Susie Orman said whole life sucks, but I've heard about this privatized banking thing. Oh my God. Cindy said, that's like saying you hate hammers. She's right, but Cindy knows. So let me describe it this way. I did this morning for the first time. I want to have you understand this in a different light. When I say the word whole life, the first thing you think of is a expensive life insurance policy, if you're like most people out there. So then I would have to ask you, is there only one kind of whole life? Is there only one way to design and engineer a whole life? Well, some people are like, I don't know. Maybe. Yeah, I only know of one way to buy it. I go to my broke ass brother-in-law. That's a Brent term. Go to my broke ass brother-in-law and he sells me a whole life and he makes a bunch of money and I have no money to use in the first few years. Yep, that sounds about right. Yep, my advisor said that whole life insurance is terrible. You should never, ever buy it. Okay, so these would be some common things. But that is assuming that a whole life insurance is the exact same thing and there's no other design. Well, let's talk about cars. I'm sure I got some car people on here. Well, I'm a rally car guy. I love rally cars. I'm infatuated with like these drivers. So Ford Focuses, like in their general form, like if you went to Ford and you bought a Ford Focus, is that a sexy car? Do you pull up in front of like a country club and be like, yo, man, check out my Ford Focus? Nope. You're not looking like, wow. You're not like, hey, man, I just roll up in my Ford Focus. This is a badass car. Dude, your Ferrari, I'll eat that thing for lunch. It's not how it works. You park your Ford Focus in the back and you don't really talk about it. It got you from point A to point B. They're nice cars, but they're not sexy. But then let's talk about Ford Focus, the rally car. It is one of the most winningest outside of Audi, one of the most winningest rally cars in history. There's a driver, Ken Block. Okay. He's got videos all over and he drives a Ford Focus rally car. It has 800 horsepower. It does things that I can't even dream of doing in a car, like going sideways at about 140 miles an hour in full control. Now, that Ford Focus rally car and that Ford Focus that you parked in the back line and you don't talk about, are they the same chassis and car? Yeah, basically it's a Ford Focus. But what's different? One thing. The rally car was specially designed to be a rally car. The regular Ford Focus was designed to be a regular car that you drive. Only one difference was design and engineering. Whole life is the same thing. We can custom design and engineer a whole life policy to do something completely different than what it was designed to do. No one would have ever thought that rally or that Ford Focus over there at the Ford dealership could do what Ken Block's Ford Focus can do, but it just took engineering. We can engineer a whole life policy to perform in a completely different way. And that's what we do. That's what privatized banking is. That's what the Rockefellers did well over 100 years ago. They created a machine out of a vehicle that has been around for hundreds of years, 200 plus years. So all I'm talking about is the environment. By putting your money, by changing one thing and changing where your money goes. Now, what money am I talking about? Well, it could be the money that you save today in your savings account. Could be the money that you're putting into your mutual fund account. Could be the extra money above and beyond the match that you're putting into your 401k. And we're going to get to 401ks in a moment. It could be any of those different dollar amounts that you're putting somewhere out of your control. Oh, but Chris, I'm in control of my bank. No, you're not. If you're putting money in the bank account, you absolutely are not in control of that money. Because if you were in control of that money, the bank wouldn't be able to use that money to make more money. And the bank wouldn't make 400 to 1,300% more than you do on your bank deposits. Last time I checked, banks don't take the money you deposit there and put them in a little box in the safe in the back with your name on it. They move your money, which means you are not in control. The bank is in control. You gave them control openly and honestly because you didn't know what you didn't know. But if we just change one thing, where that money goes first, and we change that money to go into this specially designed and engineered whole life, what happened? Well, I'll tell you what happened. You completely changed the environment in which your money operates, because that environment, as of right now, 2021, in 2022, this will not be the case for anyone that starts after 2022. Your money will earn a guaranteed 4%. And you heard me. Remember, we were talking about the 4% rule. Well, now we're getting into some of the meat and potatoes. What is the 4% rule? Well, if your money that you have right now could just operate in an environment where it earned a guaranteed 4% every year for the rest of your life, would that change things? Some of you are saying, well, maybe it doesn't seem like a lot of a return, but what if that money and every penny you put through that machine that earned 4% guaranteed, what if it never ever changed? What if you always earned 4%? What if that interest didn't stop getting paid to your account when you took the money out? Whoa. Well, what do you mean? Do I mean that I can take this money, put it into this machine, then take that money back out and not stop the interest flowing ability of that machine? That's correct. You have a perpetual tailwind on your money, 4% plus dividend. How can that be? Well, that's for another week. I'm not going to get into that, but I just want you to understand that there is a way to change the environment in which your money operates where it will earn a guaranteed 4% uninterrupted and still give you control and access to some or all of that money in time, all of it, without interrupting that flow. So now that changes the dynamic of the entire thing. So Stephen, now I know we were going to talk about 401ks. I don't want to go too deep into that. I know everybody loves talking about the privatized banking and, that machine. I just wanted to simply help you understand that the wealthy know something you don't know, and they know how to make their money work for them without interrupting the flow of interest. And that is the 4% rule that the wealthy use.
Yeah. And, taking the example we used with the HELOC earlier, and you started on it earlier. I don't know how far we got, but by adding the one step of first getting that HELOC money into this guaranteed 4% whole life policy, then taking it from there and deploying it into these private loans and private funds and, basically ways of generating this income through interest. It just adds a whole nother layer of wealth growth, of legacy creation, and of additional income that you can use even more in the future. It's we talk about the 4% a lot, and people are like, well, 4%, yeah, I mean, that's cool over time, whatever. They really don't understand the compounding aspect, because it's like, how in the hell else could this policy, I put $10,000 in it, and all of a sudden I have $35,000 available to me just like that immediately? That's a little bit more than 4% growth. I mean, I'm no mathematician, but $10,000 in the matter of days to $35,000 is a bit more than 4%. Would you agree with that? But these policies do that, and they do that every single day, and they do that guaranteed, basically guaranteed. So it's just, we get stuck in the words sometimes, and we get stuck in the little, like, what we've been taught our whole lives, like what to focus on, and we lose track of the bigger picture. But when we take a step back, and that's why I've started to do, Chris, with almost all of my clients, is I do a follow-up call with them to go over the illustration and go over the numbers, because, and I know everyone does this in mapping, but I've been doing it myself because I love seeing that reaction. I love when I hear them on the phone and you can just like hear it in their voice, like, wow, like I heard you guys talk about it. I believed it. I'm going through the process. I'm starting, but you don't really truly get it until you see it with your own eyes. And you really don't truly get it until you start using the policy and following the practice and doing what we teach you to do through IBC. And then that's when you're like, man, I'm going to tell everybody about it, and I'm going to open up multiple policies. I mean, the fact that we did a study a couple of years ago, and all of the money multiplier clients that had policies for 12 months or longer, 92% of them started additional policies. I mean, what does that tell you? It's one of those things that, all right, I'm going to believe it, I'm going to put my faith in you, but then you get to prove it to me. And once you prove it to them, they're like, wow, we're going full speed ahead. So it's just such a fun thing that we get to do every single day.
No, I couldn't agree more about that. And, I think the biggest problem with this is a lot of people, when they first hear it, they think it sounds too good to be true. And if you're one of them, if you're hearing this, you're like, wait a second, I can put my money in this place, change just one thing, and then I can access all or some of that money immediately. And when I take the money out, I don't interrupt the compound interest. Nope. That sounds too good to be true from the basis. And again, we're going to be doing a wealth webinar where we're going to explain the entire way it works and show you the numbers behind it. But if you just looked at it, the first thing when you see the numbers, you look at it and you say, that can't be real. I thought it was only 4%, but now you're showing me in the 5th year, a 10% cash on cash return. And by the 15th year, it's much higher. And, by the 20th year, it's over 100% cash on cash return. I thought it was only 4% plus the dividend. The dividend can't be that much. No, you got to understand uninterrupted compound interest. All the wealthy individuals, the hedge funds, all the investment firms, they understand that. That's the difference. But you have to change the environment, because there's no other environment where you can actually operate except for this one we're talking about, where your money will earn while you get to control and use that money. So let's just take that example. Can you go back to the HELOC example on the screen? And let's just add one step to this. And I'm not going to be able to put numbers to it because I didn't come prepared for that, but go back to that. Remember, we were talking about a home equity line of credit, $100,000 home equity line. Okay. And if you took the money out, it cost you 5%. So if we had that environment right there and we had 100 grand and we wanted to loan it out to make 10%, well, we could do exactly like it shows and you make 5,000 bucks. But what if we just added one step to this process? What if we took the 100 and we just changed where that money went first? So we took it from the bank, from the home equity line, and we put it into this privatized bank that we're just talking about, that's specially designed and engineered whole life. And then from that whole life, we immediately took the money back out. Now we might not be able to take 100. You might only be able to take 85 or 90,000 out immediately. Okay. But we take, let's just say 90,000. We take 90 grand out and we loan that money out at 10%. Well, now you're making $9,000. So I don't know the math on 9,000 a month, but you can see it's a little less than that. But what happened there? Well, here's what happened. You now have $100,000 in an environment where it's going to earn a guaranteed 4% plus a dividend every year until the day you graduate. So take a look at how old you are and then, what your expected graduation date would be. The nice way of saying your day you die. Is it 5 years, 10 years, 15, 20, 25 or longer? How much would 100,000 grow to if it were earning a guaranteed 4% plus dividend over that period of time? Now, all of a sudden, you'd start to get an idea, a glimpse, the pimple on the elephant's ass, if you will, of what that would actually result in. And most of you aren't ready for the truth. You're not ready to understand how big that difference would be because it would be massive. But that's just changing one thing, adding one step. A lot of people before that, think this is too good to be true, or right in the beginning, they're like, wait, I put 100 in and I only can use 90 of that 100 or 80 of that 100 immediately. Well, that sucks because if I just keep it in the bank, I get to use 100, right? But what are you giving up in the future? Everybody's in a rush. Everybody's in a massive rush to build wealth. And I'll tell you what happens when you're in a big rush to build wealth. Chances are you lose your wealth. You lose the money that you're trying to earn. Wealth is a marathon. It's not a sprint. So if you're trying to build wealth like tomorrow or, in a year, this isn't the right vehicle for you. This isn't the right environment for you. But if you're trying to build wealth over the long haul, wealth that can't be taken from you, wealth that will pass on generation after generation, legacy, this is the right environment for you to fly your money in or fly your plane in, if you will. So let's go one layer deeper here. Let's get into how many of you have a 401k or an employer sponsored plan? Let me ask that. If you have a 401k or some type of employer sponsored retirement plan, just put me in the chat. I just want to know. Most people do, because most people have been taught somewhere in their lives, just like I was, by a grandparent or a parent, that this is a smart thing to do. And I'm not saying it's not. So I'm not trying to create that, but if you work for a company, there's a good chance they offer a retirement plan. And what you're told when you start is, hey, how much do you want to put? It's right in your application, like right in your beginning paperwork. How much do you want to put into your 401k? And then they say, well, we match 3%. Okay. Up to 3%. So first thing you're thinking, well, if I put 3% in, I get a match of 3%. That's free money. Correct. Absolutely true. And you should put at least 3% in. But a lot of people are like, well, I'm way behind the 8 ball. I really should take advantage of this. I'm going to get a tax deduction for every dollar that I put in. It's going to come right out of my paycheck. I don't even have to see the money. Out of sight, out of mind. It goes right from my paycheck before taxes into the 401k. This is awesome. And they max it out. And they put, let's just say, 18,000, 19,000 bucks into it. But then what happens? So what you're literally doing when you're putting money in a 401k, let me boil it down, is you're doing something with your money you would never, ever do with things that money buys. And I'll explain that in a moment, but you're giving up your best dollars today. Your dollars are worth the most today. They'll never be worth more. So you're giving them up. And you're putting them in this retirement vehicle that's for someday later in the future. How long? I don't know. You just take your age minus 60 years old. I mean, that's the earliest you could take it out, 59 and a half. So that's how long you're giving up control of that money for. And when you do that, you have to also understand that your money that was worth the most today will be worth less money in the future. Oh, but that's okay, Chris. It's going to be invested in these great mutual funds, these freedom funds, these retirement date funds that they've got, these awesome mutual funds. Oh, and they don't even charge a fee. Lie number 2. There's absolutely a fee. There's a prospectus, and every one of those mutual funds has a fee. Some of them are 50 basis points. Some of them are 2%, but let's just average it out at 1%. So over 20 years, if you put 100,000 into a 401k at 1% in fees, that costs you $28,000, according to the SEC. Not me, not my math, SEC, Securities and Exchange Commission. So there are fees. But what else is, what is another reason why we put money in 401k, Stephen? Tax deduction. You get a tax deduction today. Okay, great. Well, are your taxes going to be higher in the future than they are today? Almost certainly the answer is yes. We don't know for sure, but it's almost a certain yes. So we're getting a tax deduction at today's tax rate, which will probably be the lowest in most of our lifetime. Okay. And we're agreeing that someday in the future, 59.5 is the magic number. When we take that money out, we're going to pay tax on all of the money we take out, that 4% rule money. We're going to pay tax on that at a higher tax rate than what we got a deduction for. Who wins in that occasion or that proposition there? Who wins? The government. The government wins the entire time. And who else wins? The advisory firm, okay, because they're getting fees. Who else wins? The Wall Street company that set the 401k up. Everybody wins, and you allowed them to win by giving up control of your money. So if you wanted to really change the dynamic for the money that you have in a 401k, there are some solutions. They were much better last year with the CARES Act. But Stephen, what are some things you can do with a 401k?
Well, one of the wonderful things you can do is take a loan from that 401k.
Okay. And how does that work? So I hate that word loan. You know, we were talking about taking loans from those specially designed whole lives. That's a swear word, but that one was okay because I didn't have to pay that back because it's just an advance of my death benefit. But in a 401k, I do have to pay that back, right?
Oh, yes.
So if I have a 401k or an employer sponsored plan, how much money can I take out? So this example, we did this last year for CARES Act. Please excuse us. This is incorrect by today's numbers, because if you have a 401k, you cannot take a $100,000 loan from your 401k. You could last year, but you can't this year. So we got to modify this slide for the next time we use it. But if you took a loan today from your 401k, they will give you 50% or $50,000. That's the most you can take out. So let's just cut the numbers in half. $50,000. If you were to take a loan from your 401k, it would cost you $2,500 interest only. Okay. Which it'd be a little different. But if it was 5%, it'd be $2,500. Now, all of a sudden I've got 50 grand in my hand. Now, what can I do with that money? Anything you want. So use the same example. Let's say we lend it out to a real estate investor at 10% on a first secured lien position. Okay. At 10%, if it costs you 5 and you make 10, you make the same spread, but now it's not 5 and 10, it's 25 and 5. You make $2,500. That's your arbitrage, or 5%. But is that really the whole truth here? No. If you take a loan, that 5% interest, and there's another typo there. It says HELOC interest rate.
I see that.
But,
yeah.
Yeah. Sorry. We got some typos here, but if you take a loan from your 401k and the loan costs you 5%, who keeps the 5%? Is it the financial company, Vanguard, Principal? Stephen, who keeps that 5%?
Me.
That's right.
Goes right back into my 401k.
So when you take the money as a loan from your 401k, first off, you're taking your money out of the market. Now, would everybody agree the market's at the high point? Absolutely. Market's at the highest point it's ever been at. So taking money out of the market, what are you doing? You're following what Warren Buffett says: buy low and sell high. You're selling high. So to take a loan, you have to, liquidate whatever positions up to the 50,000 you're taking. So you sell the mutual funds that you're in and you get that whatever gain you had. And now you got 50 grand, and you then take that 50 grand, you lend it out or do something with it to make more money. And that's this example. But the 5% that you're repaying that loan back over the next 3 or 5 years, whatever you pick, that 5% goes back into your account. So you literally just pretty much guaranteed yourself a 5% return. And I say guarantee and loosely, but I think you're going to pay yourself back, right? If you're an honest banker, you would pay the 5% back to your 401k simply because, hey, it's your money. And if you get to keep it all, why wouldn't you pay it back? So this is another way where you can be your own bank. Okay. You can be your own bank with money that you have already today. I mean, if I go back and I look at all the people that I asked a second ago that had 401ks, there's a lot of you. Well, are you using your 401k money wisely? Are you actually putting that money to work? I don't know. Are you? Here's a way to do it. I've done this. When I used to be at New York Life for many years, 14 years, I had a 401k. My first flip was funded with my 401k. So I took a loan from the 401k. I used it to renovate that first flip in 2006. And then I repaid that 401k back out of my paycheck it was biweekly. Biweekly, I paid that 401k back. And that 401k regenerated all of its money. I got the flip done and I made the money on the flip. So I was able to make money twice doing that right there. So it doesn't matter whether it's your flip or their flip that you're lending on. And same with the HELOC. It doesn't matter if it's yours or theirs. It's all the same darn thing. All we're talking about, folks, is changing the environment in which you operate, changing the environment, how your money moves and operates, instead of just leaving it in someone else's control, hoping for the best. It's like playing roulette, right? Red or black. Maybe you put a little on green, red or black. I hope it hits that, whatever one I put it on. But like, you're doing the same thing with your money if you're just putting it somewhere and just hoping for the best and leaving it there. And too many people do this because they don't have control of their money and they're not taking control of their money.
Yeah. And a couple of things I'll add to it, Chris. This is for an active 401k. So if you have a job, you're contributing to it, it's through your employer that you work for right now. This is a great strategy, especially right now with the markets being at all-time highs and things like that, to start thinking about and start implementing right now. Like, get that money out, because if one of the huge downsides of 401ks are you lose complete control. I mean, they give you, each plan administrator, each 401k, whatever brokerage is through, is going to offer you different options, but typically you don't have hundreds of options to choose from. You can't just use your 401k and buy individual stocks or use it to buy options or things like that. Like, they usually offer you, like, let's say 5 different funds, right? Like something, if you're young, you're very aggressive. If you're middle of the road, something kind of mixed. And then, if you're close to retirement, something more conservative and maybe a few mixed in there. Sometimes they call them lifestyle funds, things of that nature. So you really don't have much control. So, this is a great option for that. If you couple that, and then let's say you have more than 50,000 you could take out. So you got another 50,000 sitting in there, a couple 100,000 sitting in there, maybe more. Like, what do you do with that? And that's where we look at, you better implement some kind of strategy like buying insurance. Did you know you can buy insurance on your 401k? Did you guys know that? It's not direct insurance. You don't go to an insurance agent, but you learn a little bit. You get educated. You learn from a professional, somebody like Sodi that teaches 10/10 stock trading. And he teaches a strategy that's very unique called hedging. And hedging is purely insurance on the money that you have within the stock market, protecting the downside risk. I mean, he says it the best. We buy insurance literally on everything else in life, our cars, our boats, ourselves, our health, our life, everything, right? Our phones, our electronics, but we don't buy insurance on one of the most important assets of our life, which is our retirement funds. So learn that, or, look at moving that money into cash. Or if it's an old 401k, if you're out of that job, then this is not the strategy to follow at all. If you're able to, let's move that money from an old 401k into something that we can control. And my suggestion would be a self-directed IRA. You now have control of that money. Or depending on how old you are and what the amount is, maybe we look at, is it a good time to just cash out, pay the penalty, pay the taxes now before they do skyrocket, get back control of that money, and let's move into a new strategy where you're in control and you can do what you want with your money. Because let's face it, who cares more about your money more than you do? Nobody. So let's take back control of it.
Yeah. And that's well said. And, there's not one silver bullet, folks. I want you to all understand this. There's not one thing that works for every single one of you. There's, well over 100 people on today. We talked about 3, really just 2 strategies, but adding changing one thing and adding where the money goes first from these 2 strategies. This isn't the right strategy for everybody, but it is for most of you. I can tell you that much. So I just want you to understand that, like, each of you have a different need, a different goal, and a different money problem that we have to solve. And that's exactly what we have to do. So we're just trying to give you the knowledge that nobody else will teach you. There's no money for any advisor, bank broker, or anyone else to teach you what we just taught you. This is the knowledge that the wealthy understand. It's banking principles. It's you changing the environment and earning uninterrupted compound interest, or learning how to do what the bank does and make an arbitrage, a spread on the return. That's all this is. It's quite simple, but nobody's ever taught you. And this next week is going to be the biggest topic. So I urge all of you, next week is wild. All of you should join us next week for the wealth webinar. And how do you do that? You just go to chrisnaugle.com. We'll put it in the chat and just sign up for the webinar. And if you sign up for next week's webinar, and I know some of you are probably upset that we said last week we're going to have the book out to you. Well, we didn't have the book fully done. I was mistaken and I got my hand slapped for it. It is now done. That is the book right there. Okay. Drifting Away from Traditional Car Buying. It's a mini book, and you will get the mini book if you register for next week's Wealth webinar. And what we're going to cover is summed up very eloquently by Thomas Edison. And Thomas Edison said, opportunity is missed by most people because it's dressed in overalls and it looks like work. Think about that statement. Opportunity is missed by most people because it's dressed in overalls and it looks like work. People try to avoid work. And because they try to avoid work, they miss the opportunity. Next week, we're going to talk about a massive opportunity called the $1 trillion source. Most of you already have this. Most of you are already using the $1 trillion source. The difference is, go ahead.
No, it relates so much to what we did today. I mean, there's trillions of dollars in 401ks. There's trillions of dollars in equity sitting in people's home that's untapped. I mean, so just even from what we did today, this is stuff you can, again, go out and talk to your friends about, your neighbors, your coworkers. Like, hey, like, what are you doing with your 401k right now? Okay, well, let me show you some things that I'm doing. And if you need any help with, how to get that money lent out, if you need to know, okay, well, now that I have 50,000 sitting there, like, who do I lend this to? Like, where do I go to find somebody that's going to pay me 10 or 12% and back it by real estate? Well, I mean, we can definitely help with all of that. We do our Money School Essentials training class. We have something called the Private Money Club that literally connects borrowers with lenders and lenders and borrowers and provides you the education to go out and make those educated decisions. So it's right there for the taking. You just have to make the commitment, man, this is something I want to do. And I'm willing to take the little bit of effort that it takes to learn it, go out there and do it so I can control and I can take control of my financial future.
Yeah, let me just go one more because somebody did a comment that really was good. And then Stephen, if you can hit that question in there, because that's definitely not the case about you got to cash out your 401k to do IBC, not even close. You don't have to do anything like that. But somebody in here mentioned that they took a loan from their 401k and they paid off their credit card. So let's think about that. Okay, where does most Americans, their wealth goes to somebody else? Think about it. You get your paycheck and you write checks or you send bill pays to everybody else. And what you're left with is usually 10% or less. That's just how the math works. 90 cents of every dollar goes to somebody else. So one of the people on here is smart enough to say, hey, wait a second. I can build wealth if I just take back the money I'm giving away to these greedy credit card companies, because the credit card companies, what are they charging you? 15, 19, 24.99. That's what mine is. Anyone got a credit card with a higher interest rate than 24.99? Say aye. Because mine's 24.99, or actually my lumber liquidator card is actually 29.99%. So does anyone have a credit card that's higher than 24.99? Say aye. Here's the thing. Oh, somebody said many. Great. Here's the thing. Let's just say you had a 401k. And you took that loan for 50 grand, but let's just say you owe a credit card $50,000. We'll just keep the math simple. So I take the loan from the 401k at 5% or whatever your company charges, could be as low as 1.5, but I take it at 5% and I pay off this Visa, which I owed $50,000 to at 24.99%. Okay. Now what do I then do? Well, let's just say if I had a Visa that was 50 grand at 24.99, my monthly payment was probably let's just say $1,000, simple math. I was used to giving $1,000 every single month to Visa. So now what if I just change the name on the check? What if now the name on the check goes back to my 401k? So I take the $1,000 I used to give to Visa and I pay that back to my 401k. What just happened? Well, if you remember the example I just gave you of the 401k, first off, the 5% interest on that 401k loan is being paid back to your 401k. Okay. You're keeping that money. They don't get it. So you're 5% ahead right there. But now when we pay back the $1,000 that we used to give to Visa that was gone forever, left your family forever, we take that $1,000 and we pay it back to the 401k loan. How much did we make there? Well, the answer would be 24.99% interest. That's how much you were giving away. That's how much you're paying back to yourself. It's the same math. So you're paying yourself back 24.99%, plus you're keeping the 5% that the 401k loan was charging you. How much did you actually make? Well, really, if you did it that way, you're making about you're making almost 30% because it's the 5 plus the 24.99. But one thing will happen for sure in that equation is you'll pay the loan back with the $1,000 a month that you were given to Visa much faster And then all of a sudden you're going to have all this extra money because you were used to paying Visa off at $50,000. But now you didn't have to pay your loan back quite as long because you got the perpetual tailwind of the interest you were giving away. You see what I'm saying? Like, you can spin this any which way you want. So to sum up and to wrap up for today, this is a great training. I love this topic. It's just so much fun that we can kind of show you how to be the bank with money that you already have in your possession. Here's what we've got coming up. So first off, if you're watching this on YouTube, make sure you click down below and you click to subscribe and smash that bell. We want to get you as much knowledge, and all the stuff we're doing is going to be there. Every one of these wealth webinars not only are going to be cut up and put on YouTube, but we're going to put them on the chrisnaugle.com website. So we're going to create a special section. If you've been to Chris Naugle's website, there's a special section that says Wealth Webinar. All of these recordings, every one of them will be on the chrisnaugle.com website under Wealth Webinar. You'll be able to go to there and watch any of the past wealth webinars. Now, of course, if you're registered for this, we're going to email it to you. And we're also, once you register for next week, we're going to email you the book, okay? Drifting Away from Traditional Car Buying. But here's another thing that I want to point out. It's been a long ride with COVID. A lot of us have been cooped up, wrapped up. We haven't been able to do anything. And now they've started lifting a lot of the restrictions. So now we can actually get out there and start enjoying the world. We can start making memories. We can start creating experiences. So I've got one for you. And I would love for all of you to really spend and create memories and experiences with me personally. We've gotten to know each other quite well through a computer, but many of you have never met me in person. Some of you have, but very few. I want to meet as many of you as possible. And I'd love to share with you, not just knowledge, because I can do that through the computer. I want to share with you an experience like none other. So here's what we did. We've got an event coming up. It's called none other than The Experience. It's the 27th of August to the 29th. Okay. So you're going to come for a dinner here in Buffalo on the 27th. And just so everybody knows, there's no snow in August in Buffalo. It's absolutely stunningly beautiful here. Then the 28th and 29th, you're going to go through what I would probably call one of the most unbelievable experiences of any event you could. We're going to spend the entire day Saturday at my house. And we're not going to be teaching you anything. We're going to be listening to what you need, what your money problems are, where you're trying to go. We want you to tell us, and we got a template and a format for that, what it is you need help with. And then who are you going to be surrounded with? Well, Randy Garn. Okay. He exited a business called Prosper for, I think, something like 800 million. He's exited many companies. He's the coach of coaches. He's my personal mentor. Then you got Brandon Steiner, bought the Yankee Stadium. Do I need to say anything more? Then you have people like Robert Sislo on the marketing side of things, used to work with Grant Cardone. And we've got other special guests that are going to be there, me, Steven, Joseph, and a whole bunch of other people. And all we're going to do is listen to what problems you need solved. Then we're going to basically work on mentoring and coaching you the rest of the day in breakout sessions where we're really going to get down to how do we solve your problem. Instead of us telling how we can solve everybody's problem, we're going to focus on just what you need to get to the next level as fast and as efficiently as possible. That evening, this is where it really gets fun. That evening, after we do a really nice dinner out on the patio at my house, we're going to get in a limo, and we're going to take a limo back to our offices where you're going to be given a gift. And you can't open that gift until we take a walk around the corner to a theater that we rented out. At that theater, you're going to open your gift, and you're going to have something in there that will absolutely be unduplicatable. You'll never be able to get what's in that box anywhere else the rest of your life. You can't buy it. Secondarily, you're going to go through and watch something that I've seen, and that many of you never have, but you're going to meet a real celebrity. A celebrity that was in a motion picture, a huge motion picture, a football movie, but it's not just any celebrity. It's not like the actor you're meeting. You're actually meeting the person the movie was written about, who actually starred in the movie, along with other star cast. You're going to listen to their story of how they did what they did, all the things that happened. It's one of the most motivational stories ever. And then you're going to spend the rest of the evening with this celebrity and all of us. Sunday, the final day, we're going to spend time out at a private lake, a lake that is not open to the public. It is crystal clear, and we're going to do all sorts of team building activities on the lake. You can get in the water, you cannot. We're going to do all sorts of fun stuff for the entire day. Brandon Steiner is going to lead that one off, and we're going to teach you how to think like these multimillionaires that are going to be there and how they built their companies and how they got where they're at. And they're going to do that through really fun exercises at a lake. Here's the thing. There's only 25 people allowed to come to this event. And of the 25, we only have 16 seats left. So I want all of you to join me. I want all of you to join me at this event. I can't believe somebody just actually guessed it. Do not share that, Garland. Don't share that to anybody. Nobody's supposed to know who it is, but you do. So one person out of all of you knew who it was. I can't believe he nailed it, but he did. So there's 16 seats left. It's August 27th to 29th. If you think this would be something that you would benefit from, if you think this is something that would change, your trajectory to where you're trying to go, or if you just want to create the most amazing memories and experiences that you can ever, pass on to somebody else, you got to act on it quick. Steven's going to put the link up there. Actually, it's right there. There's only 16 seats left. There's payment options for it. It's $49.92 or $49.93. Okay. That includes everything except for your hotel and your airfare. Do not come with a credit card to pay for food. We got you all day long. Don't bring anything else besides a bathing suit, a change of clothes. Just bring yourself, get here. Airline flights to Buffalo are not that expensive. In the hotels that we have recommended, we have special arrangements built for this event. So that's it. That's the story. You want in, get on it, because the next time we do this, there might not be any seats left. So this is literally one of those things where literally, it's not like I'm telling you there's 25 seats and then I'm going to come back and, oh, hey, we opened another 5. No more people are coming to my house, period. So join me and Steven and Joseph and the special celebrity guest, along with Randy and Randy and Brandon Steiner and a couple other people at the experience. And I can't wait for it. And other than that, get to chrisnaugle.com and register for next week's wealth webinar so we can give you drifting away from traditional car buying. Steven, that's a wrap, man. We did it right on time.
Good stuff. Good stuff. And if you had any more questions, anything like that, either schedule a call or email me and let's talk, and then join us at 4:30 in 2 hours from now for Ask Me Anything. Grab a cocktail, a beer, a coffee, a water, whatever you want, and let's have some fun. Those are always my favorite time of the week.
Yeah, I can't wait. And I'll see some of you at the Ask Me Anything happy hour. And for a bunch of you, I will see you at the experience. I shouldn't say a bunch of you, but a select few of you, we will see you there. So there's the AMA registration for this afternoon. Outside, thank you all for joining us. Thank you for spending your time with us. We'll see you on the next one.